Good afternoon, ladies and gentlemen. We're going to get started. Thank you for attending the latest installment of the Options Industry Council's webinar series. My name is Alexander, and I'm a staff member here at the OIC. I'll be guiding you through today's session, Managing Risk with Listed Options. In today's webinar, presented by Marty Kearney, we'll be focusing on risk management techniques that can only be found with listed options. Marty has authored several books, including Options Essential Concepts and Strategies. He is a consultant to the NYSE and to those in need of his service, helping brokers develop new business with conservative option strategies such as covered writing and portfolio hedging. In addition, Kearney serves as the instructor for the Options Industry Council. We're glad to welcome Marty to today's program.
Thank you very much, Alex, and hello, everybody. Thanks for attending on a busy day in your life and a busy day in the market. And I'll tell you, there's some days that you just kind of luck out. You know, today's topic is managing risk with options. And some of you are catching this on the archived basis or during an iPod thing brought up at a later date. But today's live market is over for the day, and obviously the Dow didn't do well. The day that we taped this, the Dow was down 327, the S&P was down 40, and the NASDAQ was down 157. So as you can see, at times maybe we can use options to manage our risk a little bit and keep involved with the market. You know, I think a lot of people know that over time, the market has historically, this doesn't mean, you know, for the future obviously, but being involved in the market has historically done very well. But there can be times where either with an individual stock or a basket of stocks, you feel like maybe there is something that we would like to try to take advantage of to reduce our risk. You know, obviously enhancing return is a good idea, but reducing risk is certainly something that we'd like to try to do. So as Alex said, send those questions in, and he's got some very able assistants and myself, and we'll see if we can't get you answers. And you won't see anybody else's questions, but we do, and we'll pass those along that we can get to. And you have some good resources as well, as you will see in a second. We've got the usual disclaimers. I'll tell you about those resources in just a second. Obviously, we're not taking into account the impact of commissions, and past results are no certainly indication as to what you should do. We're not making any recommendations whatsoever. The Investor Services Desk has several people in the background here working, and we should let you know that they are available. You can send them your questions. And they are very, very good, and they try to get every question answered within 24 hours. They actually try to get every question answered that day, and sometimes you can actually catch them live. But the Investor Services Desk at the OCC is certainly something that you should take advantage of if you haven't. And all they're going to ask you, by the way, they're not mining for information to sell it to some crazy outfit. They're going to ask you what's your first name and what's your question. Okay, and they have no axe to grind on different stocks or different brokerage firms or different exchanges or anything else. As you can see by this graph, and they try to do this, so this is an annual graph, but the options have taken off in the last 10 years, and there are a lot of people trading options right now. I didn't see today's numbers, but I would think that today would be a very, very busy day for options, okay? And as I said, what people are trying to do is they're trying to reduce risk, they're trying to enhance return, or they're trying to put on a position and have a certain amount of leverage that you could get while reducing the risk rather than own an individual stock. Okay? But the option volume is good. I know I traded something earlier this week, and I got a good fill. This is a few of the exchanges involved in the whole Options Industry Council. I am representing the New York Stock Exchange today, some very good people. I know at their website, just a quick shout out to the NYSE, you can go to nysc.com and look under trade and products, and you can see the different ETFs and the stocks and ETPs that they have, and you can see if that's something that could be helpful to you, in addition to whatever your broker's website is, and in addition to the resources at the OIC and their award-winning website. So here's what we're going to talk about. We're going to talk about reducing risk. We have that risk management segment, and as I said, today would have been a day that even myself to have a little bit more of a risk management hat on, all right? We're going to talk about protective puts. We'll explain what a put backspread is. A little aggressive perhaps for you, but it could be something to take a look at. We'll also take a look at the stack repair, and that's a way to reduce risk and not double up with buying more stock on a stock that has gone lower. Okay, all right. So here's what we have, right? When you got a little sign here, when you can remove risk, do it. When you can't, you should reduce it. That makes a heck of a lot of sense to me. Heck of a lot of sense. So options certainly give you more ways to kind of implement your market research, right? You've gone to the trouble of identifying a stock that you think, should do well for whatever reason. You've taken a look at a chart, support, the volume, the products that you're using, and options kind of help you target a variety of ways to do it. And as I said, we can generate income. I do that by covered writing. Okay, but that doesn't really reduce the risk. It reduces the risk marginally. The covered write, for those that don't know, is, I own 100 shares of XYZ trading at 50, and I decide to sell the 55 strike price call against it. That's covered, the term covered write. I am writing or selling an option, and it is covered by the underlying shares that I own. And let's say I bring in 1 point. Okay, I have an obligation to sell a stock at 55, but I only brought in $1 of protection. So technically, I guess that does reduce risk, but ever so slightly. If that stock goes down $5 or $10, sure, I had $1 of protection, but that's it, right? The most I can make is whatever I sold the option for. So we use options to generate income, maybe to acquire a stock. Okay, I did a strategy to do that earlier in the week. It isn't working real well right now, but it's not doing too poorly. And we can reduce the risk ever so slightly. Okay? So as we said here, if we can remove the risk, do it. When we can't, let's try to reduce it a little bit. Okay? So the term insurance, now this is an area where some people, I've been involved in kind of discussions before with very learned people where they have saying, well, they don't like the term insurance. But I think that's kind of what it is when you're buying a protective put, right? Where you have a limited amount of time until expiration that your insurance policy takes effect. Okay, you pay a premium, all right, and the most you can lose is whatever you paid for that premium. So think about that with car insurance, with health insurance, with life insurance, right? If you've got car insurance, you don't necessarily want to crack up your car, right? But if you do, you know that you have, let's say, the $500 deductible, right? And it's due you're covered until next April. And, this is the level at which your insurance kicks in. That would be the strike price, wouldn't it? Okay? So you can use options to reduce the risk of an individual stock or a portfolio, okay? And it gives you peace of mind. You're buying insurance. I don't like writing a check for my house insurance or my car insurance, okay? But you know what? I kind of feel like I should have it. If lightning hits the house or something else happens, it would be nice to have some insurance. So I don't mind paying for that insurance. Let's talk about protective puts, okay? So here's what we have, right? We've got an investor who's bullish on a particular stock. It's XYZ. We won't use individual stocks, okay? But my concern is something crazy happens, like the market today. Okay, all of a sudden there was an announcement out of Washington, and the next thing you know, the market's down 200 points in about 5 minutes, right? So by buying the protective put, we actually have a floor underneath. At that point in time, we can actually sell a stock if we choose to do so. Okay? So it's an insurance policy on a stock that represents perhaps a large percentage of your portfolio. So when we're talking about a protective put, what we're talking about here is, right, I have an existing long option position. Okay? And you know what? I think the stock is going higher. If you don't think the stock's going higher, you know what the easiest option trade to do is? Sell a stock. Don't trade options. Get out of the long stock. Okay? But I think this stock could be running into a little bumpy area. I'd like to hang on to it. Okay? Obviously, I still have the potential for the stock to do very, very well. Okay? Which strike price I choose determines where my protection kicks in. Let's go back to that car insurance, right? Do I want the zero deductible? That would be considered to be at the money options, right? Would I like the $500 deductible? Would I like the $1,000 deductible? Each of these different decisions has a different risk profile for me. It also has a different cost basis, doesn't it? The 0 deductible will cost me more than the 1,000 deductible, okay? So you have a strike price to determine where you can exit. And by the way, here's one other thing for the 3/4 of you that have never traded options before. And we're going to have some examples coming up here. Well, let's wait till we get to the example. It's coming up in 2 pages here, okay, because we can talk about that, okay? And one of the things this slide talks about also is, do I need to protect the entire position? Okay, you know, if you have 1,000 shares of XYZ, do you need to buy 10 puts? Each put represents 100 shares, right? A standard option. Do I need the insurance on all 1,000 shares? Would I like to insure 500 shares or 400 shares or 600 shares? So you get to decide which of these you would like to do. I have a question here. Can I use a protective put on an ETF? You know what? You're 5 pages ahead of me, so hang on just a second here, okay? We're going to get to that. And the answer is absolutely, okay? Another one here, protective puts have an expiration several months in the future. Some of those do. Here's what happens if you take a look at an option chain. Don't do it now. We want you to stay with us here, okay? But whether you go to the OIC website or you go to your broker's website or an exchange like NYSE, you can take a look and see that XYZ has October options, November options, January options, February, May. You know, you have different months that you get to choose from. We're going to talk about that as well. Okay, we're going to talk about that in about 3 different pages. Okay, so actually we're going to talk about that on the next page. All right, so hang on here. Right. So how much time do I need? Now that's one of the critical questions. If it's something where you know what, this company is coming out with earnings in 2 weeks, then you know what? You don't need to buy a 3 or 6 month option. Those will cost you a lot more money, won't they? They will give you protection, very similar protection, but they will cost a lot more. Okay? Now, if you're saying, I need protection for 2 or 3 weeks, you're not going to buy the protective put that expires next week, are you? Okay, so it's kind of more of an art than a science. You'd like to get enough insurance time-wise, but not buy too little or too much. If, for example, we have weekly options, and about 1/4 of stocks have these kind of more recurring expirations, don't they? If I'm thinking about a 2-week option, guess what? I might buy a 3-week option, but I'm not going to buy a 3-month option. Okay, so how much time do you need? You've got to make that determination. How much protection do you want? Well, you know what the cost is of the stock that you own, what it is trading at right now, and that's where you have to decide, you know, which deductible do I want? How much protection? And would I like to insure my entire holding? How much am I willing to pay, right? This is the cost of what kind of deductible. Okay, and you've got to decide, I only want to risk this amount for my insurance policy, knowing that you can hopefully get out of it at some price later on if you decide to exit the position early, okay? Yeah, so here's the question about, which month, how much protection do I need? I've got a good question about selling out a put. Let's just cover that real quick. Can a put be sold back at a profit? Absolutely. Okay, you know, if you buy XYZ, or let's just take this stock right here. Let's just say XYZ is trading at 100. Let's use our example, and I'll read you the rest of the question, okay? And we've got 60 and 90-day puts we're taking a look at right now. Okay, we're saying August is 60 days from now and September is 90 days from now. Okay, if I buy the 95 strike price put for August, that middle column there, 3 down, do you see where the bid says $1.90? Okay, I don't have a pointer on my screen right now, but I'm looking at it myself here. So the August 95 strike price put at $1.90. With the stock at 100, let's say you pay $1.90. When we're not figuring in commissions, right? And let's just say the stock, let's pick a round number. The stock goes from 100 to 80. Okay, well, this wasn't a good stock to own, right? But you know what? You have real protection because the 95 strike price put that you paid $1.90 for with the stock at $80 is 15 points in the money, isn't it? okay? And on expiration Friday, the bid and ask is $1.90 and $2. You probably would have paid closer to $2 for this, okay? Well, let's use the $2. It's a nice round number. But with the stock at $80 per share, and you own 100 shares, you have a right to sell 100 shares at 95. In answer to the question, can you sell out the put? Absolutely. There's two things you can do as expiration approaches, all right? You can exercise your option, and you can deliver 100 shares and collect $95 per share, or you could sell your protective put. You paid, let's say, $2 for it. It should be, with the stock at $80, it should be, I'm thinking, worth $15 or more. You paid $2, you could sell it at $15. Now, at that point in time, there's two things. Number one, you have no insurance, right? You made $13 on the protective put, which is great, okay? But remember, the stock is down 20, isn't it? Okay? So back to answering the question, can the put be sold back at a profit? Yeah, it could be sold at a profit or a loss. If you decide you no longer either want the option, or you don't want the protection, or you don't want to exercise your option and deliver the shares for whatever reason, you can sell the option. Okay? Says, I have put on the stock, decide to sell the stock, and then sell the put. Absolutely, you could do that. Okay? Can it be profitable, say, in a bear market? Well, anytime you buy a put, if keep in mind not every stock. I was taking a look at a portfolio. I won't tell you whose it is. Okay, but this person has 12 or 13 stocks he's taking a look at. 3 of those were up today. Okay, so in a bear market, guess what? If I had a put on those particular stocks, I didn't check a look at the prices as to where I bought those puts. All right, but not every stock is going to go. It's not going to follow the market completely. If the market is off sharply today, every stock didn't go down. All right, and if you have a protective put, it doesn't mean just because the market's down, that stock is down. Okay, so very good question. So yes, you can always sell the option before expiration. You own the option, you can sell it out. If you sold an option, guess what? You can always buy it back, can't you? So in this particular case, let's get back on subject here, right? I'm taking a look at 60 and 90-day options. So the August 95 put, as we said, was 190 bid offered at $2. The September 95 put was 270 bid offered at $280. Okay, so what we're looking at here is we could buy 50% more time, right? If the August is 60 days, then the September is 50% more time. It's 90 days. And you know what? We're not paying 50% more. We're not paying $1 more for our September insurance. We're paying a little bit less than that. That's how options work. They're not linear in how they decay. They're not linear in how they are priced. Okay, and I'm kind of oversimplifying it, but you know what? This just means buying more time doesn't cost you that much more money in a lot of cases. Okay, so here's what happens. All right, we buy 3 of we're protecting 300 shares of stock, right? We're going to buy 3 of the 90-day. We went out to September. Let me back up a slide here. We went out and we looked at September, right? These are the 90 strike price puts, I believe that was. I'm sorry, the 90-day, 92.50 strike price puts trading at $2. See, 190 bid offered at $2. Hope I'm not giving you headaches, right? And here's what happens. I bought the puts. I paid $2 times 3 contracts. And remember, each option represents 100 shares. So when it is priced at $2, it is trading at $2 times 100 shares, or $200. So we're spending $600 to protect 300 shares of stock. And you know what? For a stock trading at 100, it's what, 300 shares, that's $30,000 worth of stock I'm protecting for $600. Do you see where we're getting a little bit of leverage here, right? So we get to stay in the stock. Hopefully the stock does well in the next 3 months. Okay, we do have a deductible. We paid $600, right? And we have $7.50 of risk from the 100 price that the stock is trading at now down to the 92.50 strike price that we bought. Here's what it looks like on a chart, okay? Now keep in mind, Whenever you see a chart like this and you see straight lines, I'm looking at the dotted line is obviously ownership of stock, okay? And this represents 100 shares. Whenever you see a solid blue line like this where it says, September at $97 is our break even, okay? If it's a straight line, that means we're at expiration Friday. Because today, if the stock was trading at, we came in this morning, it was trading at 100, and right now it's trading for, 99.50 with the market down today. That protective put might have stayed the same. It could have gone down in price. It could have gone up tremendously, okay, based on people's expectations. So a straight line means we're at expiration Friday. Well, what does this mean? It says, look, we own the stock at 100. Okay, if we buy the 92.50 put, we paid $2 for it. Okay, that stock, right? We would have to be at. We're long the shares at 95. We bought the 92.50 strike price put. Okay, since we paid $2 for it, the stock would have to be at $97 to break us even, right? Stock's at 95. We paid $2 for our insurance. Stock would have to be at 97 for us to break even, at least on paper, right? And you can see from that as we look off to the right side of that particular graph on the screen, we can do very, very well. The stock goes to 110, 120, we still participate, don't we? As you can see, below 92.50, we have risk, okay? In this particular case, we have risk from 95 down to 92.50. Okay, that's $2.50, and we had to spend money to buy the protective put. Okay. Here's a question: how much does the underlying stock move to make the premium go up or down? Well, obviously, if the stock goes up in price, the price of your protective put will be less valuable, won't it? Okay. If the stock goes down tremendously, the protective put kind of acts as your buffer against the stock going down. It will go up at some point, maybe pretty sharply. The in-between is where it's not the straight line, right? Because how much time is left, are interest rates involved in this, the normal components of what makes an option price, what are people's expectations about the market, about this particular stock. So if the stock goes up or down, the price of the option will go up or down accordingly. And I think that's where you need to know a little bit more about some of the characteristics of the option itself, okay? In this particular case, with the stock at 95, if I'm buying the 92.50 put, if the stock went up $1, I wouldn't expect the put to be worth $1 less. It's worth a little less money because the stock isn't at 95, it's now at 96, isn't it? Okay? But still, it will move, but it will not move, it should not move more than the price of the underlying stock. Okay? So here's where we have the portfolio. Now, this was the question somebody asked early on, right, about can you use protective puts for a portfolio as well as an individual stock? Absolutely. Okay? In this particular case, the investor has a $100,000 portfolio, all right, largely reflecting a broad-based index or ETF. So maybe this could be something like the SPY, let's say. Okay, that's the SPDR, right? It's the ETF on the S&P 500. Okay, you're worried about the market through the end of the year. Okay, for a lot of reasons. You've got things going on with the trade dispute. You have elections. You have all sorts of things. Correct. You're worried about your portfolio. You'd like to hang on to the portfolio. It took you a while to construct this, and you've got a pretty well mix of lots of different things. Okay. You'd like to buy a corresponding protective put. Okay, well, guess what? You can certainly do that. In this particular case, we're looking for protection down about 10%. We think maybe the market, we're willing to live with the first, this is phrased, I didn't phrase this correctly. Okay, I know the market's going to move up a little bit or down a little bit, but in this particular case, right, I'm going to buy the 90 strike price put. Okay, this is the 90-day. Where are we here? We're trading at 250. The underlying ETF is trading at $250. I'm going to buy the 225 strike price put. Now, this is 25 points out of the money, isn't it? Okay, so this is 10% out of the money. So I'm buying the 10% deductible here. Okay, if the S&P is down a little bit, it's up a little bit, I don't care, I have insurance on. If the market really moves down sharply, I have some real insurance. I bought the 225 strike price put going out 90 days. Okay, so the calculation on this is pretty simple. Okay, this looks complicated, all right? It's not really that bad. And here's what we have. Let me just see if there's a build on this, right? Right, so I've got a portfolio, right, of a certain amount, okay, and I would like to buy 4 of the 225 strike price puts because I'm looking at the portfolio dollars to hedge, right, about $100,000. I'm looking at what is this worth, right? It's a $250 index. You know what? That works out to, $100,000, okay? And what I'm looking at is buying 4 puts. Now, in reality, it always doesn't work out exactly right. For example, I looked at the S&P yesterday, was trading at, the example I looked at was the triple Q. It was trading at 175. Well, if I was trying to hedge $100,000 worth of the triple Q, that's the NASDAQ 100, correct? Well, would I buy 4 or would I buy 5 or would I buy 6 protective puts if I wanted to protect the entire section of my portfolio? Okay, 5 protective puts would cover me for $85,000 worth of my portfolio. 6 protective puts would cover me for $105,000 of my $100,000 portfolio. Okay, so in real life, you know what? It's never going to work out exactly right. It could theoretically, it could be right on the button. But this is where you have to decide, what's my concern? Okay, that I've narrowed it down to in this example on page 19 here, I've narrowed it down to I'm concerned about this broad-based index, of which I have $90,000, $100,000 of risk, right? And you know what? This is what I think I'd like to do. I'd like to buy 4 protective puts. This does a pretty good job of reducing my risk. This is going to cost me it's going to cost me 4 contracts, right? $3 a piece, right? It's going to cost me about $1,200. Okay, and I do have the risk of where this index is down to my strike price plus whatever I paid for the insurance. Okay, so it's kind of like back to the car, right? If I've got a $5,000 car and I have the $500 deductible, and I were to pay in this case, right? I were to pay $300 for my insurance, I have risk from $5,000 down to $4,500, and I had to pay $300 for the insurance, didn't I? All right, so I have no risk below $4,200 in that example. And it says, as it says here, you can buy fewer puts if you'd like to hedge less of the position. Let's see what we have here. Okay. I had a question somebody just sent me, and I lost it. Okay. Right. Oh yeah, somebody said here, should I be buying for my portfolio? Should I be buying the triple Qs, the Qs that I talked about, or the SPY? Well, it depends. It depends on what portfolio you're trying to protect. So if your stocks are more of the the larger cap stocks, maybe the SPY would be a better product to buy insurance on. If you're concerned more about some of the NASDAQ stocks in your portfolio, NASDAQ down so far this month. Now remember, you might be seeing this on an archive basis. NASDAQ so far this month is down about 7%, isn't it? Okay, then maybe the Qs would be a better thing you should take a look at. Okay, so anyway, should you buy Qs or should you buy SPY or buy something else? It depends on the makeup of what your stocks are. And you can go to the website of the exchanges where these products trade. Okay, today I'm representing the NYSE, but you can go there and you can take a look at the SPY. What does the SPY? How is it composed? Okay, what is the weighting for the different products in there? What are the Qs? What makes up the triple Qs? Okay, and you can take a look and say, hey, you know what? The stocks that I own kind of seem to more line up with the S&P. Then you know what, you should be using, if you wish to use protective puts, maybe the SPY would be a better product for you. Okay. Okay, so here's what happens at expiration. Okay, and this is with the 225 strike price puts, you own 4 of these things, don't you? You paid $1,200, okay? And in this particular case, let's take you down to, let's say that the market went from, on this particular basket or index, I'm sorry, this basket or ETF, it went from 250 down to 200. Do you see where 200 is, right? So the ETF is down 20%, and that's not good, okay? But you know what? You hedged by spending $1,200, the 225 puts, that's a plus 10,000, isn't it? So the market's down 20%, you lost 11%, 11.2%. That's not great. Losing 11% is never something you want to write home about, right? But you know what? If you did not hedge the position, you would have lost another, what is that, another $8,800, okay? But you used a protective put, and you know what? Look at this. If the index itself goes from 200 down to 175, the ETF, I'm using interchangeable words here. You know, if the market is down 30%, you know what? You're still down. Look at the bottom, on the total column here, the very bottom number says, in red, 11,200, okay? You know what? Your loss is limited. If you bought the correct number of puts, okay, that matched up with the corresponding portfolio you were trying to buy the protection on, guess what? It's kind of truncated off there, okay? So once again, this is why people buy protective puts. I'd like to put a floor underneath the stocks that we have, okay? Let's take a look at a put back spread. Now, we can go quickly through this section, okay? This is something more that traders do, all right? You may not do this, all right? But it's important that you will hear terms mentioned like on the financial TV shows, and you will hear it by people when you listen to webinars, things like that, people will talk about this. Okay, what this says is, look, is there a way for me to put a position on with very small initial costs that should the market collapse, okay, should the market go sharply, sharply lower, that I can do well? The answer is maybe a back spread, all right? And what we're looking at here, let me back up and cover this, okay? All right, we're going to see here in a second where the underlying is, but I'm going to sell a 60 strike price put and use the proceeds to buy 2 of the 55 strike price puts, okay? So what we're looking at here is we're selling something closer to the underlying value, okay, and we are buying something further out of the money. It's the same expiration, okay, and the option I'm selling, in that case the 60 put, is covered by the 55 put that I buy, and we bought an extra 55 put. So it's kind of like selling a vertical spread for credit, but we're using the money to buy an additional put, okay? And whenever you hear someone says, I did a ratio spread, this is a ratio spread, isn't it? So if I was talking to Alex that started out, or he kicked off our campaign here, hold on, yeah, I'll get to your question in a second about protective puts, right? Yeah, if someone says to me, if Alex says, Marty, I just did a ratio spread, what he's telling me is he did a spread, and it's not a spread where like he bought 3 and sold 3, or bought 5 and sold 5. What he's telling me with the ratio spread is the number purchased and the number sold are a different number, okay? He bought a little more of one and sold a little less of the other. So you have back spreads and front spreads. A back spread says I'm buying more options. That's all that a back spread is saying. It's a ratio spread. I'm buying extra options, okay? And there is no magic number down on the bottom, you know, contracts bought and sold at a ratio. Could be 2 to 1, could be 3 to 2, could be any number you want. But a ratio spread just means the numbers I'm buying and selling are not equal contract-wise. And a back spread says I'm actually using, I'm buying more, the number of contracts I'm buying is greater than the number that I sold, okay? So with the back spread, what's happening here is sometimes you can put it on for a little credit. That's what the top dotted line is. Sometimes you can put it on for little, if any, cost. Sometimes it costs you just a little bit of money. I don't like putting back spreads on if they cost me money. That's just an aside to you, okay? But the idea here is that the problem we have is if the market goes down just a little bit, you could actually lose a little bit of money. Now, the question will come in occasionally, would I just be better off buying a deep out-of-the-money put? Sometimes you might want to do that. Sure. Rather than do the 60-55 1x2 backspread, maybe you should just buy a 50 put. It's not real expensive. It's what? It's 10 points out of the money on a $60 stock, right? But once again, that's where you have to decide, and you should model it, right, with maybe some software that your broker has, and see which one of these things works out better. Okay? I'm looking at a sharp decline. I'm not spending a lot of money on this. I'm trying to put this on for a small net credit, maybe close to break even. Okay? Why am I doing this? I'm not sure if this market is actually, or this particular stock is really going to collapse. Okay? If I really think it's going to collapse, as I said early on, maybe I'd like to sell the stock. Maybe you own it at a very low cost basis. I'm not getting into the tax implications here, okay? But you know what? There is a chance. The trade-off down here is that there could be a kind of a spot where you actually end up, it's costing you just a little bit of money, okay? Here's a question. I'm going to get back to the other question in a second that I skipped here. If there's a long position, should I use a trailing stop with the underlying stock? A stop order just means that, I own the stock at 60 and I'm worried about a big collapse. Should I put in an order to sell this on a stop basis, let's say at 56? What that means is, as long as the stock is somewhere around 60, a little higher, a little lower, there's no big deal. If it trades at 56 or lower, you're giving your broker instructions, sell the stock. The problem there is, what happens if the stock goes down to 55 and then back up to 60? You just gave your broker instructions to sell it down below 56, didn't you? Okay. Could you use a trailing stock stop? Easy for me to say, along with puts. You could, but you're kind of mixing up different strategies together. Okay. The traders that use stops are traditionally traders that trade futures contracts, where maybe they're not in front of their computer all day, and they have a position on, and if it turns against them, they just want to get out. So I'm not a fan of stop orders on stocks. I would rather buy a protective put, because the market was down earlier this week. The market was down 500 or 600 points on Monday. It was up 300 or 400 points on Tuesday. You might have been out of the market near the bottom on Monday, not participated on the rally on Tuesday. That's why I like protective puts. I buy the insurance when everything's fine. Okay. Hopefully, I don't need it. The stop order takes you out of the position. Somebody says here, can you only buy a protective put if you have a self-directed account? Yeah, if you have a self-directed account, that's good. But you might have. I have. A part of my portfolio is in a managed account. I know ballpark-wise what positions they have on. Okay. And if I decide I'd like to buy a put in my regular trading account, okay, that kind of is protection for something that my money manager has, absolutely. Okay, so it might not go right into your a managed account type portfolio, but you could mimic your own insurance. What section of the market is concerning you? If you have a position in there with a self-directed account, great. You can match it up. If it's a managed account, it's kind of off to the side. It's a little insurance, and nothing wrong with having a little insurance. Okay, so that's the back spread, right? In this case, I'm going to sell it with XYZ at 47. I could sell a 50 put, collect 4 by 2 of the 45 strike price puts, right? So I'm selling a put. What? 50 put is $3 in the money, all right, and I'm buying 2 protective puts that are $2 out of the money. I'm putting this on for a net credit of $1. If this market goes higher, I think we're going to see the break-even points here. Yeah, if the market goes higher, all the puts expire, I make $1. Now, that's before the transaction costs, okay? If the market goes lower, you know what? I could actually make money on this. But I'm looking at a very sharp move lower, and I do have this point in the middle, right? As the market, let me back up here and tell you where that is, because it's not identified on the graph, right? If this particular basket goes from 47 down to 45 at expiration, the 50 put you sold is $5 in the money, right? And you only collected net, I'm not including commissions here, I only collected $1. So as you can see, if this market goes sharply lower, heads down to 45, you could be out $400, all right? your break-even point is 41, but below that point, if this particular basket of stock goes below 41, you know what? You could be making money below that point. Okay. All right. Let's move on here. Okay. Yeah, your break even, you can do very well. Okay. If your break even is 49, you have two break even points here as well. 41 or below, you make money. 49 or higher, the most you can make is your dollar. Okay. Hold on just a second here. Your break even point. Okay. There are two break even points. What is your risk reward on a simple put or calls? Well, it's whatever you can make on the option compared to what you paid for it. Okay. Hold on just a second. I want to make sure I'm on with Alex here. Bear with me.
Yeah, you on.
All right. Let's move on here. To put back spread at expiration, let's just hustle on through this, okay? All right, I'm assuming you can hear me here, okay? Yeah.
Loud and clear.
What we're good. Okay, thank you very much, Alex. Okay, so as you can see, right, above $41, we make $1, okay? And if we own stock, we're still only making $1 on the right-hand side here up at the top of that right column, okay? On the downside, guess what? If this stock heads down to $35, you can make $6. There's a big landing area in the middle, right, where you could be losing money, all right? So just be aware of what the put-back spread is. We're not going to, go great detail into this, okay? And take a look at, what points does this really hurt me? In this case, for example, if the stock only goes to 45 and stops, I'm short of a put that's $5 in the money. My protective puts are worthless, aren't they? Okay. Okay, let's talk about the stock repair. This is one that I have done before, okay? Now, let's just assume that you got into a stock earlier in the week, like I did, okay, and the stock is not doing very well right now. Well, you could do nothing, okay? You could and pray. You could double up. I don't recommend that, okay? We used to, down on the trading floor, we used to call it double up to catch up, okay? Or maybe there's a way that we can reduce our break-even point and not cost us very much, if anything, okay? So this is called the stock repair. Now, this is a good one just to keep in mind. Write it down and take a look. After this is over, later tonight, have a soft drink and sit at your computer and take a look at one of the stocks that you have that's down a little bit. Maybe you can see a way to reduce your break-even and you can repair the stock price, okay? You're going to have little additional funds, if any, required. The problem is we're going to be cutting off the upside. Let me show you what it is, okay? We're going to see the example here in just a second, okay? What we're going to do is we bought 100 shares of stock. We bought it at a higher price. It's not working, okay? I'm going to buy one option closer to the current strike price, okay? I'm going to sell 2 out of the money options. Now, wait a minute. Marty's talking about buying one option and selling 2 on the call side. We don't want to have naked call options, do we? Well, one of the options we sold is covered by the shares we own, and what we're doing is we're using the proceeds of that to buy a call vertical spread, okay? Can I do a repair on an ETF? Yes, you can, but we're just going to use it on a particular stock, okay? So let's see what this is, right? It's generally appropriate on a stock that's down 5, 10, 12%. If you've got a stock that's just been completely clobbered, the stock repair might not get you back to the point of breaking even, okay? And we won't know that until we get there. But let's take a look at an example on the next page. Okay. In expiration month, we don't want to go out real far if we don't have to. We want to keep this in. Don't go out 3 months if you can go out 1 or 2 months. Okay? So let's just see what this looks like. You bought 100 shares of XYZ at 70. The stock is now down at 60. So what is that? It's down 12, 14%, isn't it? Right? On paper, you have a stock loss of about $10. That's not good. Okay? So here's how we do this, right? Let's buy a 60 call. Okay, the stock is near 60. I'm going to buy an at-the-money 60 strike price call for $3.50. I'm going to sell 2 of the 65 strike price calls at $1.75 each. I'm going to put this on for what? I'm going to put this on for 0. Okay? Now, I haven't put my commissions in here. So what do I have? I own 100 shares at 60. I have a call option that I own at 60, right? 60 strike. I have an obligation to deliver 200 shares at 65. Now, 100 of that is the 100 shares I own. The other one is I'm long the 60-65 call vertical spread. Okay? This does not protect me to the downside. That's not what I'm hoping for here. I bought the stock at 70. What I'm trying to say here is if the stock it's currently at 60. If this stock can get to 65, I'm delighted. I am thrilled to just get out of this thing at break even. So I'm trying to lower my break-even point, okay? Right? Between 60 and 65, I have a problem. Let's just pick a price. Let's say that the stock, now it's expiration week, it's expiration Thursday, the stock got back to $64, okay? Okay, remember I bought the stock originally at $70. I'm still down 6 on the 100 shares I own, don't I? Aren't I? The 60 call that I own with the stock at 64 is worth $4. And remember, I didn't pay anything other than any commissions involved to put on the long 60 strike price call. So at 64, I'm still down 2 points. Okay? So this is where if the stock, you'll see here on the next slide, right, if we get the stock back up to 65, right, I break even, right? Above 65, I don't participate because I have an obligation to deliver my 100 shares, and the 60-65 call spread can only go to 5 points, right? So I'm down 5 on the stock, and my long call vertical spread that I spent 0 for would be worth a plus $5. Okay, so as you can see here, at 65 or higher, if you look at that right column, I don't end up any money. With making any profit. But remember what we originally said here. I bought the stock at 70. It's currently at 60. If I can get out of this thing at 65, I'm thrilled. When I was in grade school, we started something called the new math. I don't know, if you're younger than 60, you don't know what I'm talking about. But the new math, to me, it seems as if it's going to be easier for this stock to get from 60 to 65 than it is to get from 60 to 70, okay? So I'm just saying there's good and bad here. The good is I'm lowering my break-even to 65. The bad side of this is I don't participate above that. I just want to break even. I want to lower my break-even and get out of this thing. So this is called the repair strategy. So back to the question somebody sent in, can I do a repair strategy on an ETF? Sure. If you bought SPY a few weeks ago and it's down, take a look at if you think that there's a chance that SPY could head a little higher here. Maybe it doesn't get back to the point where you bought it, but if it gets a little higher, maybe I could do the repair strategy by overlaying the repair. Buy close to an at-the-money call, sell 2 out of the money calls. Traditionally, these are all the same expiration. Okay. Let's see what else. Yeah, can I lower the cost of a protective put? Going back to one of the earlier questions here, by doing a put vertical spread. So here's what somebody's saying, right? They own 100 shares. It's not on the screen right now. They own 100 shares at 50, and they want to buy some protection. Okay. Could I buy the 45 put? Could I sell the 40 strike price put? Yes, that would require you to have approval from your broker to do spreads. Okay, so buying a put shouldn't be a problem if you're approved for options. You want to buy a put spread, you might have to fill out a little additional paperwork about doing a spread. So all of these trades that we've talked about where a spread is involved, you might want to check with your broker, make sure you're approved for that. What you don't want to do is try to put a trade on that you see, and then they say, oh, wait, we need you to send in paperwork, and we'll get you approved by the end of next week or something, right? Okay. When we're talking about, let's go back to this repair strategy, okay, you're giving up some upside, right? In this particular case, we lowered our break-even down, but you know what? We lowered it to 65. Once again, I just want to get out of this thing. That's the idea with the repair strategy, okay? Keep in mind another thing, too. Whenever you put these spreads on, one of the things I warn people about is, hey, today is Thursday of expiration week, let's say, okay? Keep in mind that you might have option positions on that are in the money or slightly out of the money. Take a look about, should I be adjusting these, should I be trading out of these positions today or tomorrow, okay, rather than have some of these new positions turn into more stock. So, for example, on this repair strategy, remember we bought the stock at 70, it went down to 60, and using my example, the stock has now rallied up to 64. That's great, but if we own the 60 call, and tomorrow is expiration Friday, and we close kind of in this range, we could end up owning a second 100 shares. Now, it would be at 60, wouldn't it? Okay, but is that your objective? All right, to own a second 100 shares. So just keep in mind that when we put these trades on, what will this trade look like at expiration Friday? Okay, let's see what else we have here. If there's any more questions before we get to the end. I just had a question come in. Yeah, here's a question. Could I use a collar as a way to reduce a risk? Well, here's what a collar is. We'll tell you that real quick. We've got a couple minutes here. Okay, you know, we've got a stock at $50 a share. Rather than just buy a protective put at $45, the 45 strike price put, could I sell a 55 strike price call against it to protect myself? And the answer is sure, why not? That's the collar, right? I'm selling a covered call. Stock's at 50, I sell the 55 call. I use the proceeds to buy insurance. Okay, now I have risk between 50 down to 45. I have potential gain from 50 up to 55 where I sold the call option, my covered right. Okay, so absolutely you could use a collar to protect a position. I don't see any other questions coming in here. I don't have anything else. Alex, do you have anything else? We're down to 2 minutes until the very end of this presentation. Do you see any other questions coming through here?
Yeah, I just got a question come through. Can you explain the risk difference between weekly, quarterly, and leaps against normal options? Is that something that you can speak to?
Sure. Okay. So weekly options, as I said, you know, about a quarter of the stocks have options going out 1 week, 2 weeks, 3 weeks, 4 weeks. Okay. These are the most traded options. These are the stocks that are the most active, et cetera. Okay. All stocks they're in a quarterly cycle. You know, so we might be in the October, January, April, July cycle, et cetera. Okay. So they're randomly put into a quarterly cycle. About 20% of stocks have options going out as far as about 2.5 years. Those are called leaps, long-term options, okay? When we're talking about risk protection, I think for the most part, most people, the sweet spot to me on the protection is somewhere less than 60 days, okay? You know, you're even 90 sometimes, but 60 days, this could get us through almost the end of the year. Okay, but right now it's closer to, 75 days, okay? But still, we don't have to go out real far. If we'd like to buy more protection, we can certainly do that. I know of one fund that, and you don't have to find this fund, you can do this on your own, right? They buy longer-term protective puts. They sell shorter-term calls against positions. This looks like a collar, doesn't it, where they have long-term protection, and each incremental month doesn't cost them that much more, and they are selling out-of-the-money calls that they think will expire very, very quickly. So you can cobble together, you know, there is no one right answer as to I'm concerned about X, Y, Z, and I don't want to sell it, should I buy a 1-week option? Should I buy a 2-month option? Should I buy a 6 or 10-month option? It just depends on what is your concern, okay? And then take a look at the pricing, okay? And what will this option cost? You know, what strike price? How much deductible would I like to absorb the risk of? And then you have to make a determination, what is the best course of action for me, okay? And what is the right strategy? So I would say you could use short-term, you can use longer-term, but I think kind of short to middle is the sweet spot. In other words, you know, somewhere from 2-3 weeks on up to 2 months or so would be the spot where, you know, I'm concerned about the election, I'm concerned about this, I'm concerned about, you know, other concerns going out to next year. That's a different problem, isn't it? Okay, but having some protection on for a set period of time is not bad at all. Okay. Alex,
Thank you, Marty. I know. Well, we do have a few questions coming in, but we are at our hour mark.
Okay.
I think we can have our investor services team follow up with the remainder of the questions, and then you know, give everyone their rest of the afternoon back. With that, ladies and gentlemen, thank you for your time today. While we weren't able to get to all your questions, you can reach out to our investor services desk via options@theocc.com. Again, you can reach out to them directly by emailing them at options@theocc.com. For further education, please visit optionseducation.org, the OIC's website, and check out the MyPath assessment to gauge your options knowledge. If you would like to discover more, be sure to check out our upcoming events and register for our webinars and seminars if we are in your area. You can check out our next week's webinar seamlessly by clicking the URL link at the bottom of your console, and that'll take you to you know, a registration page to sign up for next week's webinar. Finally, be sure to follow us on social media, like our Facebook page, follow us on Twitter to stay current with OIC's latest offerings. And with that, thank you again for attending, and we hope to see you next time.